panel discussion is on everybody's favorite or least favorite topic, seemingly, the smart beta, strategic beta, and the continued growth of strategic beta strategies in the market. My name is Joe Anthony. I'm with Gregory FCA. We have a booth in the back. I'll be your moderator for this discussion. Looking forward to hearing from each of our panelists. Now let's go around the horn here. First, to my left is Steve Kretschmann. He's the head of America's Index Wealth Advisory and Channel Management for MSCI. His firm has more than $9.5 trillion in investments benchmarked to its indices and currently has more than 750 ETF products that are based on MSCI's indices. Steve is an executive director and head of Americas there with MSCI. He joined the firm 2 years ago and leads the firm's effort in the wealth management space with their push around the indexes. Next up, to his left, is Jay Jacobs. Jay is the director of research at Global X Funds. His firm has more than 45 products in the market. As Director of Research at Global X, Jay oversees Global X's research team and supports clients with product education and insights. He's also worked on Global X's product development and committee and previously helped manage 15 new product launches for Global X. To his left is Nick Stonestreet. Nick Stonestreet is the CEO of Vidant Financial. Nick's firm does two things. They're an ETF issuer and they also provide trading services for other ETF issuers. Nick, as the founder, actually has 4 products on the market, 3 which trade under the Vidant brand. His firm espouses a multi-factor model for constructing his indices. And lastly, on the end is Todd Kassler. I believe your firm is the most recent entrant, the ETF space on this panel here. Todd's firm is John Hancock Investments. They recently partnered with DFA to bring a suite of products to market. He runs the institutional business for them, and in September, his firm brought 6 multi-factor strategic beta ETFs to market, including a large cap, a mid cap, and 4 sector-specific products. So that's our panel here and who we're going to hear from today. Just to kick us off, in our panel discussions, just prepping for this, we're having a little bit of a joke amongst the 5 of us about the fact that there's so many different names that are being applied to the smart beta, strategic beta space. We're hearing scientific beta, smart beta, strategic beta, factor tilting, et cetera, et cetera.
Better beta.
I see that from my position as a somewhat of a challenge to get investor interest in this space, understand really what it does. Start off there. What do you think about smart beta in general? Offer your individual take and what are the challenges and opportunities we have? Steve, I'm going to start with you.
Sure. Thank you, Joe. And good morning, everyone. I'm Steve Kretschmann with MSCI. At MSCI, we don't refer to it as smart beta. We call it factor investing. So one of the family of companies that's been part of MSCI since 2004 is Barra. We work very closely with our analytics team, the Barra team, and we really look to seek out and have developed 6 factors that have shown to have the most risk premia and explanatory power over a good 40-year period. So our perspective on it is that investors are looking at factor investing, and we'll talk a little more about it, but multi-factor investing.
Great. You're up, Jay. Tell us your point of view.
Hi, guys. I'm Jay Jacobs from Global X. We started in the business not at all involved in smart beta. We provided access to emerging markets and commodity producers. And around 2011, we didn't think about it as, hey, let's launch smart beta funds. We thought about it as, let's try to achieve a target outcome. And the key outcome that people were asking was, how can we get more income? And so solving from getting to that goal and working backwards was how we sort of arrived at a smart beta strategy, as we would probably call it now, which is our super dividend suite, which is the highest dividend payers in the world. More recently, we launched a suite of scientific beta ETFs, which, another terminology for smart beta. I guess I would say this, there's truly a million different ways you could do smart beta. As soon as you leave market cap weighting, there's so many different combinations of factors, how you define the factors, how you weight those stocks. And really rooting it in academic research is really key to sort of cut through the noise with how many products we have these days.
And Nick, your firm is relatively new, a couple years old. You've done well. You got close to about $1.5 billion in 3 of your smart beta products. Tell us your point of view.
Yeah, I mean, I would agree with that view on factor investing, and our world is a little bit different. A lot of people have really ideas that are seeking assets. We actually had a key client that we created bespoke ETFs for. They had assets that were more seeking certain factors that they wanted in their portfolios. And so the best way to achieve that for us was to create factor models that would be reflective of their investment thesis, and that's how the Vidant funds came into being. So really it was more reflective of ETFs that we could create with better quality through what we consider better leadership and governance and other important factors to us. But I quite agree that these things have to be validated. If you're going to call something smart beta, which we agree with more the factor investing, it needs to really be smart, right? It doesn't just need to be kind of a one-trick pony that's disguised as smart beta now because that's what people are buying. I think that's an insincere way to go to market. So for us, we weren't even convinced that we were going to do ETFs. We just really sided on the side of the investors and found that to be the most efficient way to put these factors into people's portfolios.
Terrific. Todd, weigh in, please.
Sure. So, I don't know if I can add anything else. The way that we look at the world is there's kind of three buckets that people will invest in. You have traditional active management, you have cheap beta, and then everything in between. And smart beta has kind of filled that middle bucket that's kind of halfway between cheap beta and active management. Now, there's got to be some definable process associated with it. There are going to be factors that are going to be incorporated. I think what's important is are the factors sensible? Are they persistent across markets? Are they pervasive in markets? Is there a long history of data? And then is it cost effective to be replicated inside of some kind of packaged vehicle? And so as we looked at the smart beta space or the factor space, we decided to partner with Dimensional Fund Advisors, who's had a long history. They have a 4-factor model. And so whichever way you define it, I still think you come back, and I agree with the other panelists, that it's going to be about the factors. And whether you call it smart beta, strategic beta, I think that's really irrelevant at this point.
So I saw a big number in an article this week that said smart beta products now account for $500 billion in invested assets. The global ETP asset pool is estimated by many around $3 billion. That's 1/6 of the market already for something that feels like still a new phenomenon. As you take a look at that, Todd, we're going to start going back with you. You're on the distribution side. What is your take? Why is this taken off from a sales perspective, from an asset growth perspective? What's your view? Is smart beta the cure-all for the distribution problems a lot of firms are facing?
So I don't think it's the cure-all. I think it's just one of the solutions that will be used as part of the process. ETFs are here to stay. I think that you will continue to see the growth of smart beta. The challenge for the advisor community and the professional investor community is how am I going to use these in my portfolio? So there is an education gap that's there that's going to need to be solved for by the manufacturers. I think the other piece is there are so many different choices and options. Just like any part of the business, those will get shaken out, and you will have a handful that are the leaders. This is, I was sharing with the other panelists, many of you may have experienced the liquid alt craze that started in 2008. Well, it's much the same way as smart beta. There were lots of firms that came into the marketplace. There were some that were very big, some that were very small. The question was it going to be sustainable? And here we are today with the assets north of $1 trillion. I think you're going to see the same kind of growth, but it will evolve over the course of time.
So, Nick, this question is for you. As you look at it, so we have $500 billion. That's a big number. At the same time, in the multi-factor space of smart beta, that number is a lot smaller. Your firm plays in that space a bit. Tell us why you think that multi-factors haven't taken off. Is it just lack of new product entrants, or do you think it's the complexity issue that might be slowing things down?
Yeah, I mean, there can be complexity with it, but I think it's really in its infancy. And so if you see the numbers, it's going to continue to progress, Joe. When you look at a broad-based, inexpensive beta ETF, I mean, those have served investors so well. And so, from our view, it'd be kind of arrogant to say, that's not a great way to go. We all know Jack Bogle and Vanguard's done such a fantastic job for investors and being on the investor side of the equation. And we really relate to that. At Vidant, we actually ended up giving away the company to an oversight trust for investors. So none of us own shares in Vidant. We capitalized it and then we gave it away. So we like that mentality, but where we think maybe Jack isn't as focused is on adding more factors, and that can really accomplish something. And we believe it can, and we believe it will. So we're excited about the growth in smart beta or multi-factor investing. And I think the more investors come to understand it, the more that they'll use it as a portfolio tool. So it's got a place, and it'll continue to have a place, and I think it'll have a growing place in portfolios.
So, and Jay, in your firm, you actually coined scientific beta, which leads an outsider to think there's something unique or special, more advanced, more different algorithms. What's your firm's approach? Tell us a little bit how you break down smart beta and why you've taken that approach.
Sure. So we partnered with an index provider called Scientific Beta, and they're an indexing business within the EDHEC Risk Institute in France. They coined the term scientific beta, and their approach is if you're looking at the multi-factor space, you shouldn't be carving different approaches to different factors. You should be able to apply one methodology that applies across the board to all factors. If you don't do that, you can open yourself up to factor fitting or trying to manipulate results to look good in a back test. Mm-hmm. And so their scientific approach is we have a hypothesis, we're going to test it, and we're going to test it across every factor and see if it works. And so they've developed a multi-factor strategy that we track with our funds that takes that approach.
And Steve, I'm not going to ask you to take sides, but with MSCI being having over 750 products benchmarked your indices, some of them are in the smart beta space, some aren't. How does one weave through that and be able to make sure that they're true to the index? They're, as Kevin O'Leary said, making sure there's not a lot of style drift or things like that. From your perspective, how do you wade through those issues for the investor?
Well, for me, it starts with exactly what my role is at the firm. I mean, MSCI has been around for 45 years, primarily to sell and license our index data. I've been with the firm for about 3 years now, and I have a different take on it. I'm out in the advisor community talking to investors about investing and trying to bring kind of institutional know-how and institutional experience to the financial advisor community. So in those conversations, we start with what we call our ACWI framework, the All Country World Index. So it is the complete market capitalization set. We could talk all we want about Kevin's comments about full market capitalization, but it is by definition what the cumulative investor in the world holds. So that lends to a little bit about what was said earlier, where the smart beta or factor investing sits someplace between passive and active. It is rules-based like passive, and it can provide alpha like active can. So we don't take sides at MSCI. We are still strong believers in active management. We obviously license out for passive management, and we've become very, very involved in the ETF business as the index underlying products for a variety of ETF providers in the market cap space, in factor investing, and in other areas as well, currency hedged, environmental, social, and governance, and so forth.
So Steve, you brought up something that I think is really interesting. Obviously, smart beta really does sit in between active and passive. At the same time, Nick had mentioned he admires Jack Bogle and what he's done for the investor. Think about the ETFs came on the scene from an external perception. They did get a lot of recognition from the standpoint of being low cost, transparent, easy to use. There's some people complaining that we're departing from that. We're getting away, we're getting too complex. It's no longer just a friendly tool, cheap beta tool for investors. There's things going on. Nick, from your perspective as an admirer of Bogle, how do you reconcile that in terms of, okay, trying to keep it cheap and simple and affordable and understandable, as well at the same time getting better and not just being complacent in what we're offering?
Yeah, so when you look at S&P 500 fund, the Vanguard group would think it's worth like 6 basis points. So that's okay. It's a one decision. It's cap weight. So it's one decision. If you're going to have more innovation in the solution, it's going to cost more. I mean, notwithstanding, Goldman pricing, but it's going to cost more. And then there's also a place for active, right? So we were asked to create a smart beta or multi-factor fund for emerging, the far end of merging and frontier investing. And frankly, we said no, it didn't really fit, because when you get to that place, I mean, what index are you going to build to pick one of the 2 stocks in Rwanda? Like, that's just not going to work. This is a ground, in our view, for an active manager. And so there's going to be a place, definitely a place for active management. There's going to be a place for systematic factor investing, and there's going to be a place for, if you've got a fairly simplistic thesis like, cap weighted, why should it cost so much? So there's room in this whole continuum for each of these solution sets, and I think it's actually a real boon for investors that they're able to have so much more choice and not just be stuck with the low end and cap weighted, and not just be stuck with active management, but they have a whole group to pick from, including factors that they may have a proclivity for. I think this is an important part of investing. It's going to continue to grow.
Jay, you were nodding along when I asked that question. Nick, do you have any thoughts on that question?
Sure. So I think it might sort of sound like treason, right? Everyone's been rewired to think that market cap weighted exposures is the purest way of playing a market or the most efficient way. And maybe it's not. Maybe when that was created, it was really designed to reduce transaction costs, and that was really its key purpose. But we've seen transaction costs come down, we've seen liquidity come up. So then you sort of pose a question, is there a better way to do this? Are you getting the most reward for your risk? And I think when academics have researched it and they've looked at these factors, one of the keys that comes up is if you're investing in market cap weighted indexes, you're exposed to the wrong factors. You're exposed to large cap over small cap. You're exposed to growth over value. That's inherent in a market cap weighted index. So you're not just neutral because you're in a market cap weighted index. So if you start to approach it from a new way and say, okay, let's start over. Let's see if we can get the factors that are rewarded over the long term. Can we get better diversification than market cap weighted indexes? Then it starts to open up a whole new world of smart beta, or what we call scientific beta.
And one of the things we talked about on our prep call for this panel was the idea that at a certain point you can do so much testing and so much research on factors that it might actually skew what you're trying to do. Steve, I think you might even had a comment on that. What is your take on how far is too far to take these factor testing, and how far is too far to play with these indexes in terms of actually coming up with a product that's going to serve the investors and do well for your company?
The best way for me to answer that from our perspective is that you have to look at long periods of time. So we have all these factors and we've studied them over a 40-year period, and what we've found is that if you look at any of the 6 core factors, momentum and yield and value and so forth, that they will in almost any environment and in any country or region outperform the parent index over that long period of time. But there's no free lunch, meaning that over short periods of time, over any 2, 3, 4-year period, you can find any of these factors that will significantly underperform the parent index. I know I'm kind of leading us a little bit toward multi-factor investing, but that is our perspective on that. You have to look at these factors over long periods of time.
So let's shift the gears. Let's look at distribution for a second and how these smart beta funds get applied by advisors and investors. Todd, on your end of things, you partner with DFA. Firms are known for great education. When you walk in, how do you tell an advisor how these fit into portfolios, how you use them? Are they direct replacements? Are they portfolio complements? Walk us through your opinion there.
Yeah, so there's really 2 parts to it. So if you look at the world, roughly 55% of assets are controlled by some kind of professional buyer today. That's someone that's got some kind of due diligence process that they're going to employ to make an asset allocation decision or put something on a recommended list that an advisor would use as part of their portfolio. Even if you're an advisor that's running an active asset allocation, you have some process that you're going to employ in order to make that investment decision. Cheap beta is a relatively straightforward decision, and we've been in a market where cheap beta has been the place to invest for the last 8 years. So the question is, and we saw some volatility last quarter, was that the best place to invest your clients' assets? No, probably not. You wanted something else from a portfolio construction perspective. So the first thing you have to do is you have to start with the due diligence. Most due diligence is done around active products, and that's a 5P approach: people, process, performance, predictability. Well, how do you apply that process to a smart beta strategy or strategic beta strategy? So most firms today do not have something in place around recommended smart beta ETFs. Most firms aren't versed in doing that. Even in the consulting community, they haven't gone to that place. I think that will happen over time as that community starts to add products to recommended lists and model portfolios. It then leads to, okay, how are you going to work with the advisor to incorporate this into their portfolio? Now, you do that as a standalone also, but it's a very difficult discussion. So you think about how many positions you have in your individual portfolio. Maybe it's 10 to 15. All right, you're going to replace something or add it. Well, are most people doing sector rotation? No, they're doing core positions for the most part. So then it becomes a discussion around all right, how does it fit, where does it fit, what are you trying to solve for? And so most organizations, what they're doing is they're employing portfolio construction specialists. So if you look at our firm as an example, plenty of others, Natixis, et cetera, they have individuals that are going to sit down and work with the individual advisor around how you add various strategies to the portfolio. So I think what's going to happen is these portfolio construction specialists are going to become a much more important part of the decision-making process. The other thing is because of the efficiency of the transaction, you'll see people take positions based upon various scenarios in the market. So if spreads are real wide, well, then I'm going to own something that's going to be focused on deep value. If spreads are narrow, well, maybe then we index. So there is a complete education process beyond just, okay, I like this particular product. Okay, how are you going to do the due diligence? And then once you've done the due diligence, where does it fit in the portfolio?
Great. And not to put your firm on the spot, Todd, I'm going to ask this question to Jay, because Jay's firm, on the issuers up here, has 45 products, the most active products of the issuers. And as your firm is longer established, what do you make of it when you see big firms like John Hancock, Goldman Sachs, Fidelity, all of their initial or early products are in smart beta type products? What does that cue to you as a product developer, as an issuer? What do you think about there when all of a sudden you have these big Wall Street behemoths come in on the smart beta play? What's your take, Jay?
They pretty much have to come into smart beta. All the market cap stuff has been done. They're not, Goldman's not going to come out with an S&P 500 ETF, so they have to have a new take on it. The reality is the devil's really in the details. We see a lot of marketing materials come out, and everyone's talking about the same factor exposures. There's really some key differences between the different providers that are coming out with their funds and their strategies. For example, we've talked about the value factor a couple times. How do you define the value factor? Some people call it price to book, some people call it PE, some people call it dividends. It can run such a wide range, and yet it's all rolling up into the value factor. So what are those differences there? And we've seen different providers come out with different definitions. The other difference is how much sensitivity to that factor do you really want? The value factor has shown that it outperforms the broad market over the long term. Do you want the S&P 500 and just the lowest half by price to book, that half with good value characteristics? Or do you want to dial it up even more and just go for the 5 companies out there that are the deepest value and take on additional idiosyncratic risk in those companies, but be really dialed up in the value part of the chain? So that's where the devil is in the details. What is the methodology? How do they define these characteristics or these factors? And how much sensitivity to those factors are they getting?
This question's for Todd. One of the issues I mentioned came in with cheap beta pricing for their smart beta products. On the distribution side, obviously you think the price point could be an advantage. What is your take there? Where do we go with smart beta pricing on products? Are we going to see them come down to the 7 to 10 basis point range? Or do you think they live somewhere else in the 30 to 40 basis point range? What's your firm's take on that?
So I think cost is absent in the face of value. And so it's going to be dependent upon what people perceive as the value for what is being constructed. Now, offering a smart beta product at 90 basis points, which is equal to, we'll call it active management, I don't think that those days are going to be long. Mm-hmm. I think that the pricing will come down dramatically, but if you look at the industry in total, pricing is coming down across the board. It's not just in ETFs or index funds or active management, hedge funds, et cetera. So cost is a very important factor, but there again, it's cost is absent in the face of value. So if you're getting a return on investment and you're helping shareholders, people are willing to pay for that. But there will be some range that will be acceptable, whether it's category average and below. But cost is an important thing that we think about when bringing product to the market.
And Steve, as you look at the index construction side of the business and people are coming with new ideas, how difficult is it your job to come up with new angles, new ways to slice it, new ways to help them out and to modify those indexes? What are you doing in order to make sure that the next products are another set of Me Too's out there?
Fortunately, that's not my job at MSCI. But all kidding aside, I am out, one of the few people within our firm that are out talking to advisors and soliciting that kind of feedback. And we'll bring that feedback back to our ETP team at MSCI. We'll hash out all of those kinds of things. And we are in constant conversation with all of the ETF providers about these kinds of ideas.
One thing I had heard was that eventually all ETF products that are were born as cap weighted will have a smart beta version, a leverage version, and a currency hedge version. Nick, do you agree with that approach to the market? We're going to basically see all these different flavors of the same ideas over time?
Yeah, I think they'll cover the spectrum. I think you'll continue to see people, you know, a lot of the ETF providers. I mean, Wisdom Tree really hit it with Japan Hedge, right? And so now, you know, you're going to end up with everybody chasing, you know, hedge. We're going to have, you know, Guatemala hedged, and then, you know, so everybody's going to throw ideas at the wall and see what sticks. And then, you know, you look at etfdeathwatch.com, you'll see where a lot of those ideas end up. So, yeah, you'll probably get different iterations and different versions. And on the pricing issue, that's really interesting. It was interesting that Goldman priced at such a low level for their beta, and given their branding. We were on VC Street the other day, and I expected to see a greeter in front of Goldman, and maybe they have the Goldman greeter, but because of the pricing. So that to me was really kind of odd, but you know, I don't think sort of race to the bottom pricing has to be there, but I agree that with the point that it's got to be good value for investors. And I do think that when you're bringing out these factors and you're doing that kind of research, you're going to get a better solution with good value for certain factors that investors want. One of the things that I think was important that Jay mentioned is some of the unintended consequences of cap-weighted investing, which is concentration risk. So I think it's good that as investors we're having these discussions now about different kind of risks, and you'll continue to see a proliferation of really smart products like Japan Hedge and other products that will come out to address investor need and investor risk. I think the interesting thing will be how investors sort through all of this in order to get the right solutions in their portfolio. I don't think any of us have a lack of information. I think we have a lack of context. And so I think the winners going forward are going to be the people that can really provide context around these different types of solutions and how they'll actually fit for investors.
So I read a piece on the Reform Broker blog earlier this week by Josh Brown. He gave 5 reasons why basically he dislikes or has a distaste for smart beta. He gave the bear case in smart beta. I'm going to go around the horn here and ask each of you, what do you think is the most overlooked benefit, thing that's not talked about? I know smart beta has been talked about fairly extensively in the press over the last year, but think about it from your perspective. Is there anything you think investors, either advisors or individuals, should be thinking about when they're looking at these products? Steve, can I start with you?
Sure. So if you look at each of these individual factors, again, over a long period of time, you will find that each one of them provides higher returns, lower risk, or both, you know, relative to their parent benchmark. So, you know, I think it's just a matter of, you know, each individual investor, you know, just the way they would normally manage money to decide, you know, what's their bent on the market right now. Should I go pro-cyclical, you know, meaning should I be in value, should I be in momentum, or do I want to get more defensive now? And there are a suite of products from, you know, that are based on MSCI indexes and all of my fellow, you know, panelists that can suit almost all of those needs.
Jay, do you have any thoughts on that?
Sure. I mean, I think investors really need to think about what is their ultimate goal with what they're trying to accomplish. You know, if market cap weighted investing and cheap beta is their goal, then that's a great way to achieve that goal. If their goal is to increase income, then maybe you should think about a smart beta strategy. But it really comes down to what they're trying to achieve with their investments.
Nick, any thoughts you want to add?
Yeah, I think brands matter. I mean, I would hold Global X funds in my portfolio. I'm a big fan of Global X. DFA with John Hancock, I think those brands, you know, we aspire to have brands like that and a brand like that. So for us, you know, thinking about investors' trust is really important, and the brands are really important. You know, we were joking around before the panel, and we talked about ETFs are kind of like, you know, you've got waiters in Hollywood that all have a script under their arm. Well, it seems like everyone seems to have an ETF idea. It's sort of like an app idea, but it's an ETF idea. And so there's been some that have been extremely successful, one-off ETFs, but I think as an investor, I would lean more towards a family that I could identify with, like a DFA, Hancock, or Global X. It elicits a certain amount of trust when a family of funds has a defined view of the world.
Todd, anything to add on that question?
The question becomes, is there too much product out there? That would be more of the issues. If you think about all the beta ETFs now, all the smart beta ETFs, all the active mutual funds and investment options, how many options do you need? Obviously some are better than others, but how do you sort through all of that? How do you determine which one's the most appropriate for your client? At the same time, giving your client the appropriate care after the sale. And so all of this product growth can create a lot of noise that could have a detriment, or it could have an impact on the client care and the client returns. It's too much an issue for the market.
Well, we've been very fortunate to have explosive amounts of data at our disposal, technology to help us sort through it, and we continue to find evolutions in product design, things like that. Nick, your firm actually just took over a forensic accounting ETF, and you're going to start using some of those forensic screens. Is that part of the next generation for smart beta screens like that for quality? Give us your take on why you took over the Flag product.
Yeah, well, we really like the idea because a lot of our thoughts are around leadership and governance and corporate honesty. And one of the ways that we really feel like corporate honesty is reflected is in the numbers. And we met John Del Vecchio, who wrote a book called What's Behind the Numbers, and had started a forensic accounting ETF. And it hadn't really moved that much. And we wanted to really understand it better. Because this is an important part of factor investing. You want to find a persistent and unique return stream. And so when we deconstructed John's long-only ETF, trades under the symbol FLAG, F-L-A-G, we found that there was really noise in the weighting scheme, and that there was noise in some of the sectors that the forensic accounting factors drove towards. But when we just isolated the forensic accounting factor, we really found a very interesting and persistent return stream. So we isolated that return stream and repackaged it as a long short. So it's a 130/30 fund now. It's just kind of relaunched a couple of months ago, because the forensic accounting piece really works well on the short side. I know Volkswagen is not a forensic accounting issue, but when people lie and cheat, they get crushed eventually when they're discovered. And that happens a lot in forensic accounting too. So there's a whole history of that. So we really felt like the unique return stream was what we needed to work with. And this is one of the really great things with factor investing. If you find some really interesting factors that are persistent, you can take them and you can mold them into an investment. And this is now molded into 140 large cap names long and 40 names short. And it's kind of we would consider it kind of a large cap enhanced liquid alt strategy. But yeah, it was really interesting to pull that apart and reconstruct it.
Hey Jay, Global X is constantly bringing new ideas to market. What do you see as the next generation here for smart beta? Now we have all these players. Obviously, to keep new product coming out, you have to have different thinking, different ideas. I don't want you giving away your secret sauce, but do you see anything that's on the horizon, or maybe it's already started to arrive to market, that you think represents the next age of thinking in smart beta?
Yeah, I think it really comes down to multi-factor. That's nothing new. We've talked about it a little bit on this panel already. We've seen over 40 products come to market and only about $2 billion in assets in the multi-factor space. So it's an area where the ETF issuers are a little bit ahead of the market. And I think there's a lot of interest in the space, and the question comes down to what are the differences, what are the methodologies, how are these things constructed?
And as the four of you look at this space, going back to the other question I asked you about the overlooked, what areas do you think are most overhyped about smart beta? Steve, you want to take that one?
Most overhyped. Off the top of my head, I'd say yield, right?
Yield.
I mean, it's one of the things that we also deeply rooted in research at MSCI is we look at crowded trades. Mm-hmm. Based it on 4 factors. We look at hedge fund holdings, mutual fund holdings, a couple of other factors, and yield seems to be a very overcrowded space right now.
Any other thoughts on the panel on that?
Well, there's been an evolution, right? So you went from cap weighted to, when Wisdom Tree originally launched, it was more of a dividend play, like a good idea around dividends. And so you've seen progressively more analysis and complexity come into the space. So, the thing I'd worry about is, are people kind of overfitting data to create smart beta? That would be a big concern. But underneath that, if you can get past that, I think that we're adding a lot of really intelligent factors into these models, and I mean, I think it's going to continue to grow, but you've got to see this has been an evolution to this point. You know, what was smart beta a few years ago now looks like, oh, instead of one decision, which is cap weight, then it's 3 decisions around dividends, and now it's a multi-factor models that are very complicated.
So as you look at, go ahead, Todd.
I was just going to say, one of the concerns is related to this is going to be the back testing of factors and data. So a lot of this information is being used, you know, looking in the rearview mirror, driving forward. And so yes, it looks great, and I've never seen a back test that didn't look great. And so then the question is what happens in real time when the portfolio goes through some kind of stress? So that could be an issue as it relates to some of these factors. The other thing as it relates to product development, I think you're going to see more traditional asset managers unbundle their asset allocation process, meaning that if you're a manager that's got 50% quant and 50% fundamental, the quantitative process that you're employing is actually a factor weight model in some fashion. And so you're going to probably see a lot of managers start to come to market and say, this was the quantitative screen on the front end, and we're going to make that available in an ETF or package. So you could see more traditional asset managers come into the market as they have to deal with the redemptions that are taking place in active.
And how do you see smart beta playing in with a lot of the ETF strategists? Historically, they've done a lot of work with iShares and traditional cap weighted. Do you feel, are you seeing enough pickup with ETF strategist community to using more smart beta products? At 500 billion, I would say probably some, but do you see that being a big driver for growth going forward?
I mean, the strategists, obviously the group, the top 25 control about $100 billion in ETF assets. So if you're a distributor of ETF products, that's one of the first places you go to have discussions about your product. However, you're handcuffed by all of the things that they're going to apply. So they want 90-day, 1 year, 3 years of price data. They want a certain level of AUM. They may look at a back test, they may not. And so, yes, you want to go meet with those individuals. However, they have a very definable process associated to what they're doing. Now, just like any asset allocation provider, they're going to look for product that can help improve their returns. You know, but to the point here is they'd rather work with one family in many cases, and you know they've historically dealt in cheap beta versus more expensive type products. So I think they'll get there, no differently than the traditional asset allocators. But as a manufacturer of product, you're going to try to identify those customers that are using the products.
And so this question is for everyone on the panel. We got to 500 billion fairly quickly in smart beta. Obviously, the multi-factor smart beta products are just taking off. How soon do we get to $1 trillion for smart beta? Are you thinking it's something we'll see in the next 18 months, or do you think it's a longer slog from here now that we've got kind of established in the marketplace? Jay, can we start with you?
Well, it took about 20 years to get to the first trillion in assets in just US ETFs, and then it took about 3 years after that to get to 2 trillion. So honestly, I wouldn't bet against assets in the ETF space.
Nick, any points of view on how fast smart beta grows from here?
Yeah, I mean, I would say I can't give an exact number, but we all see the trends, right? We see the flows. Assets are flowing more and more towards ETFs, and assets are flowing more and more towards smart beta. So I don't see that, you know, this isn't like a trend that's just going to reverse all of a sudden, because it makes sense.
Great. Well, that's all the time we have. Got the signal wrap up. So thanks, everybody. Appreciate your time.
Thanks.